is important, which is dependents unearned income and what is a standard deduction for a dependent. Now, I'll first give you a scenario. Where is this going to be? See, a dependent, let's say there is a couple. Okay, so let's say there's spouse one, there's spouse two, and they have three children. Okay, one of their children is a daughter who's, let's say, 15 years old. Now, in the US, they promote financial independence from a very young age, and children do work their summers out getting some money. So imagine if this girl, let's call her X, okay, this girl goes and starts working in a restaurant, just for an example, okay. So this girl starts working in a restaurant for her summers, and let's say she earns some $6,000 during 2 months of her summer vacation. Now, the restaurant owner, when he pays her the $6,000, do you think he should be deducting tax at source, or in the American language, do you think there should be some tax withheld on this 6,000 before he pays this girl $6,000? Yes or no? Okay, very good. Somebody has been studying. Yes, right? So ideally, let's just assume some amount, simplicity, 10% tax or 15% tax was deducted. And then we would say, okay, so 15% of 60,000 is how much? 600, 900 was deducted. And this girl was paid $5,100. Now, this $50 is the income of that girl. Can this income be clubbed with her father or the mother? Because she has not reached the age when she would be having a separate existence, right? As far as the IRS is concerned. So we say no. In the US, we have given complete independence to children, and we have said that children can file their own return. If they earn, they can file their own return. And why would she be filing her return? Because she wants the refund of this $900, isn't it? She would want the return of this $900. It's her earned dollar. Her amount of income is way less than the standard deduction amount. So I know that she should be getting this refund. But how are you going to get this refund? So we say, okay, let us bring out a separate set of deductions that are applicable for dependents, considering that we're not expecting a lot of money to flow through them. At the same time, what if there is a child artist who would be making a lot of money filing his or her own return? So there are two scenarios. First is normal scenario, something like this. There is earned income. Why is there an earned income? Because this person has been working. This is the first thing that we have to take care. What if this person has a lot of earned income? Then how much? Then am I going to treat that person still as a child, or am I going to treat that person as somebody who's an adult? Okay, because that person is making a lot of money. And remember, we're talking about a dependent, and we know that if it's a dependent child, we don't really care how much money is that child making, so long as the child is not providing more than 50% of his or her own support. The second problem that happens is unearned income. What is unearned income? Unearned income is passive income. What if the parent, knowing that the child would be having a lower tax brackets or lower standard deduction and stuff, now the parent knows that I'm going to be taxed at a very high tax rate because my marginal tax rate is around 36%. So what I do, I siphon off my funds and put it in the deposit in the name of the child, and the child's money starts generating income. And the parent is very happy because that money would be taxed at the child's lower tax rate. That's the place where IRS comes in. Now, in India, what we do is we generally club this income with the parents' income, and we say that you need to club it with the income of the parent who's having the higher income. In the US, we have given this option to the taxpayers. We've said, let's see, if you want, you can club it in the income of the parents. But if you want, you can still treat it in a dependent's return. So you can file a separate return for the dependent. But all of this unearned income, we will give you some exemptions, but all of this unearned income would be taxed the parent's higher marginal tax rate. So it's like saying, instead of clubbing the child's income with the parents, I would still be taxing it in the return of the child at the parent's higher marginal tax rate. And that tax is called kiddie tax. That tax in the US is called kiddie tax. Okay, so there are two things now. The first thing is, what is the treatment of the earned income? Okay, yeah, you're correct, Sakshi. Just let me finish the thoughts. So first thing is, how much is the standard deduction allowed? Now, we are going to treat you like a child till the time you prove to me that you have so much of money that you should not be treated as a child. You're earning a lot of money. You're earning probably more money than that of an adult. So we say, okay, let's first begin with the assumption that you're a child. And when I say you're a child, I would say either you're less than 19 years, that means you're a high school student, or you're a student who's carrying on with a college, but you're less than 24 and you're a full time college student. So you're principally a person who's being taken care of financially by your parents. And in that case, we say that the standard deduction. So I'm looking at a scenario like this typically, that if there's a child and that child is working and that the child is earning some minimum amount of money, the child is still filing his or her own return. And here we would say we would give you a standard deduction, which would be higher of the two figures. I have taken a ballpark figure and I have assumed that for a child, if the child is running his or her own errands, 1300 would be good enough for a standard deduction. But in case if the child is earning a lot of money, so if a child has an earned income which is really high, then I have told you to take your earned income and add a top up of 450 to it, and we're going to continue this till the time the child reaches the adult's standard deduction. Because at the end of the day, I cannot allow more deduction to the child than an adult. And to an adult who is single, I'm allowing the standard deduction rate of 14,600. So what is the standard deduction for a child? It's either 1,300 or the earned income plus $450, restricted till the maximum of 14,600. Remember, this earned income is only earned income. This is not passive income. Okay, so you cannot have royalties, rent, interest, dividend, capital gains, and all of that. I'm talking about wages, salaries, bonus, commission, all of that. So that's the first thing, that for a child, the standard deduction is either 1,300 or you would take earned income plus 450 till the time you bring it up to $14,600. But then comes the second concept of what's a kiddie tax. Kiddie tax is a tax which is imposed on a full-time student or a child who's claimed as a dependent on somebody else's return, but who has a lot of unearned income. Unearned income is passive income. I have interest, dividend, capital gains, rent, royalties, all of that. And in this case, we will still let the dependent child file the return, but an amount which is equal to unearned income minus maximum twice the amount of the standard deduction. So first 1,300 is for standard or itemized deduction. But in order to earn this unearned income, if you're paying to the tax advisors or all of those expenses, I'm going to allow you a higher expense. Otherwise, I'll give you the maximum deduction of 2 times that of standard deduction for a dependent, which is $1,300. So minimum, you will get a 2,600 deduction from unearned income. But after that, if there's any extra, that will be taxed at the parent's marginal tax rate. And this tax is called the kiddie tax. Okay, let's take a question. I think it's a very good question. And if you understand this question, you would have understood both the provisions really well. The call of the question is, J. Smith is an unmarried individual who's 15 years of age and is claimed as a dependent by his parents. So I know he's a child who is less than 19 years of age. So that child is a child that we're looking at as far as a standard deduction and kiddie tax is concerned. He received an income of 6. That means this person's earned income is $6, and there is a passive income which is unearned income of $700. You're supposed to calculate his taxable income, and you're also supposed to calculate the amount that would be taxed at his parents' marginal tax rate. That means if you look at it, what is his gross income? The total amount that this person has earned is 6,450 plus $2,700, which makes it $9,100. Now, first you've got to look at the standard deduction, because when you calculate his taxable amount, now that amount can be split into something which is taxed at parents' higher marginal tax rate or something at the dependent's tax rate. But what is the standard deduction that you would get? Can anybody tell me what would be the standard deduction that this person would get? So we get to the rules of standard deduction. What is it? It's either $1,300 or it is earned income plus 450 restricted to $14,600. What do? We say, okay, I would get either 1,300 or I would get 6,450 plus 450 which is equal to $6,900. So in my example, the standard deduction would become $6,900. So the total taxable income in the hands of the taxpayer is now 9, out of which 6,900 we remove as a part of standard deduction. So the total taxable income, which is the answer for your first question, your total taxable income is now $2,250. Now, but out of this, how much are you going to tax at the parent's marginal tax rate? So we say, okay, if I have to calculate a kiddie tax calculation, I'm going to first start with the unearned income because I'm not going to put kiddie tax on the earned income of the individual. So unearned income would become $2,700. From there, I'm going to deduct the first amount, which would represent my standard deduction of $1,300, and the second amount, which could be the higher of the $1,300 amount or the amount spent for earning the unearned income, whichever is higher. So in my example, it is still $1,300. So I know that $100 would be taxed at parent's marginal tax rate. So out of 2,250, I would have $100 that would be taxed at parent's higher marginal tax rate, which would be termed as kiddie tax, and the balance 2,150 would be at the dependence tax rate. This is a very good sum that has explained all the provisions really well. What is standard deduction, what is earned income, what is unearned income, what is kiddie tax, and how are all of these related to one another. We have tied up standard deduction, we have tied up dependence, unearned income, we have tied up earned income of the dependent.